plans. The U.S. tax code has created an incentive for individual Americans to save for their retirement, in the form of the Individual Retirement Account, better known as the IRA. Traditional IRAs. Created in 1974 with passage of ERISA, IRAs featured tax-deductible contributions and tax-deferred accumulation. Anyone who earns income can set up and contribute to an IRA. Those who are married can set up a separate IRA for their non-working spouse. The annual contribution limit is the same for both. Contributions remain fully tax-deductible for workers who are not eligible to participate in a qualified employer plan. However, since 1986, the deductibility of IRA contributions is questionable for those who work in a company with a qualified retirement plan. Traditional IRA contributions. Traditional IRA contributions are made on an after-tax basis and are limited to the lesser of the worker's earned income or the current year's IRS limit, $6,000 in 2022. IRS limits may increase annually. Catch-up contributions. Workers age 50 or older can also make additional catch-up contributions can be made into a non-working spouse's IRA as well, provided he or she is over age 50. Allowable funding instruments. The tax code lists the types of funding instruments that can and can't be used to fund an IRA. While annuities are permissible funding instruments, life insurance cannot be used to fund an IRA. Traditional IRA deductions. Whether or not an individual's IRA contribution is tax-deductible is determined in a two-step process. Determine if the individual is eligible to participate in a qualified employer plan. If no, IRA contributions are fully deductible regardless of income. If yes, go to Step 2. Compare the individual's modified adjusted gross income, MAGI, to the current year's IRS contribution limit. If MAGI is less than the IRS limit, see chart, a full or partial deduction is allowed. If MAGI exceeds the IRS limit, no deduction is allowed. Please pause the audio and review the table. Key point. Do not confuse the ability to make IRA contributions with the ability to deduct those contributions. Anyone with earned income can contribute to a traditional IRA and enjoy tax-deferred growth. Whether or not the contributions can be deducted depends on one's eligibility to participate in a qualified employer plan and his or her modified adjusted gross income, MAGI. Traditional IRA distributions. There are IRS rules dictating when distributions can, and must, be taken from an IRA. If made too early or too late, a distribution will be subject to penalty taxes in addition to ordinary income taxation. Taxation of IRA distributions. Retirement benefit taxation follows a simple rule: contributions that are tax-deducted going in are taxed coming out, while those that were not tax-deducted going in are not taxed coming out. Interest is always taxable upon distribution. With traditional IRAs, this means distributions from IRAs funded by tax-deducted contributions are fully taxable. Distributions from IRAs funded by non-deducted contributions are partially tax-free. The part representing contributions is tax-free. The part representing interest growth is taxable. Death benefit. At an owner's death, any remaining IRA funds are paid, and are taxable, to the beneficiary. They are also included in the value of the deceased owner's estate for estate tax purposes. Premature distributions. Withdrawals from a traditional IRA before age 59.5 are subject to a 10% penalty tax in addition to ordinary income taxation. The penalty tax will be waived if the distribution is made for any of the following reasons. The IRA owner dies or becomes disabled. The IRA owner has medical expenses that exceed 10% of his or her adjusted gross income. The distributions are used to buy a first-time home. The distributions are used to pay higher education expenses for the owner or an immediate family member. The distributions are used to pay health insurance premiums while unemployed at least 12 weeks. The IRA owner takes them as substantially equal payments over his or her life. The distributions are used to pay for a qualified birth or adoption. Example: Francis, age 55, made a withdrawal from her traditional IRA because she wanted to take a European vacation. Because the distribution did not meet any of the qualifying exemptions, it will incur a 10% penalty tax as well as ordinary income taxation. Had she made the withdrawal to help pay for her son's college expenses, she would have avoided the penalty tax but would still be liable for ordinary income taxation. Required minimum distributions. IRA distributions must begin no later than April 1st of the year following the year the owner turns age 72. Not only must distributions begin by age 72, they must be of a minimum amount designed to distribute the participant's full account value by the end of his or her life expectancy. This explains their name, required minimum distributions, RMDs. Failure to take an RMD results in a stiff tax penalty equal to 50% of the difference between the amount that was taken and the amount that should have been taken. For example, if an IRA owner's RMD is $5,000 and only $1,000 is distributed, the owner will owe a tax of $2,000, i.e., 50% of the $4,000 difference between the two amounts. Roth IRAs. Introduced in 1997, Roth IRAs provide back-end tax benefits. Contributions to a Roth account are paid with after-tax dollars and cannot be deducted. But the earnings on those contributions, as well as the contributions themselves, are entirely tax-free when withdrawn. Roth IRA eligibility. Roth IRAs are available to anyone whose modified adjusted gross income, MAGI, is less than the current year's IRS limit, see chart, whether or not they are covered under an employer retirement plan. Please pause the audio and review the table. Roth IRA funding. The annual contribution limits for a Roth IRA are the same as those for a traditional IRA, see above. Married Roth IRA owners can set up a separate Roth IRA for their non-working spouse. The annual contribution limit is the same for both. Multiple IRAs. A person can maintain both a Roth IRA and a traditional IRA and can make contributions to both in any given year. However, the maximum amount that a person can contribute to the two is limited to the individual contribution limit. Example. Sarah, age 42, contributes $2,500 to her Roth IRA in 2022. She can also contribute to a traditional IRA. Because the maximum IRA contribution limit for 2022 is $6,000, Sarah can contribute up to $3,500 to a traditional IRA. Roth IRA distributions. The main attraction to owning a Roth IRA is that withdrawals are tax-free, provided they are a qualified distribution. Qualified distributions. To be a qualified Roth IRA distribution, two requirements must be met. The account must be held for a minimum of 5 years. The distribution must occur after the owner has reached age 59 and a half, or when the account owner dies, or when the account owner becomes disabled, or when the distribution is used to buy a first-time home, limited to a lifetime maximum of $10,000. If these requirements are met, no portion of the distribution is taxable. Premature distributions. If a withdrawal is taken before the end of the 5-year holding period, then the earnings portion of the withdrawal is taxed. Because they were not tax deducted, Roth IRA contributions are never taxed when distributed. If the withdrawal is taken before age 59 and a half, the earnings portion is subject to a 10% tax penalty tax, in addition to ordinary taxation, unless it was due to any of the exceptions applicable to traditional IRA premature distributions. No RMD. Unlike a traditional IRA that requires minimum distributions at age 72, a Roth IRA does not require distributions at any age. The funds can be passed on to beneficiaries and heirs income tax-free. IRA rollovers. Provided certain rules are followed, retirement plan participants can transfer, rollover, their retirement savings from one qualified account into a rollover IRA without being taxed or penalized. There is no limit on the amount of money that can be transferred into a rollover IRA. However, only one rollover from an IRA can be made to another, or the same, IRA in any 12-month period. How to complete a rollover. Retirement plan distributions can be rolled over to an IRA in one of two ways. Direct rollover. The participant can request that the plan administrator make the distribution check payable to another retirement plan or a rollover IRA. The check will be mailed to the participant, who has 60 days to roll it over to another plan or IRA, and avoid taxes. No taxes are withheld from the transfer amount. Note, if the check is made payable to the participant, taxes must be withheld from the distribution even if the participant intends to transfer it into an IRA. Trustee-to-trustee transfer. The participant can request that the current plan administrator or IRA trustee transfer funds directly to a new plan or IRA trustee. No taxes are withheld from the transfer amount. An IRA owner has 60 days to complete a direct rollover IRA transaction after receiving funds for transfer. If the funds are not deposited within 60 days, they are subject to tax and a potential tax penalty. Example: Brent, age 48, has worked 10 years for High Tech, where he participated in the company's 401k plan. His current account value is $75,000. He has decided to take a job with a new company. Rather than take a taxable distribution or simply leave the money with High Tech's 401k plan, both of which are options, he decides to preserve the tax deferral and bring the funds more under his control by opening a rollover IRA. He could request that High Tech's plan trustee send him a check for $75,000, payable to the rollover IRA trustee, which he would then deposit into his rollover IRA. As long as he did so within 60 days of receiving the funds, there would be no adverse tax consequences. Brent prefers the convenience and safety of a trustee-to-trustee transfer. The High Tech plan trustee makes the transfer check payable to the IRA trustee and sends it directly to the rollover IRA trustee. This avoids the risk of missing the 60-day deadline. Roth conversions. A traditional IRA can be converted into a Roth IRA, in what is called a Roth conversion. Anyone can convert a traditional IRA to a Roth IRA. Current income taxes, but no penalty taxes, are payable on the full value of the traditional IRA at the time of the conversion. After that, all distributions are tax-free. For your review, anyone with earned income can contribute to a traditional IRA, but the deductibility of contributions is limited if the IRA owner is eligible to participate in a qualified employer plan. If contributions were tax-deducted, IRA distributions are fully taxable. If the IRA was funded with non-tax deducted contributions, only the interest portion of IRA distributions is taxable. Life insurance and collectibles are not permitted as IRA funding vehicles. Married IRA owners can set up a separate IRA for their non-working spouse. The annual contribution limit is the same for both. Required minimum distributions, RMDs, from traditional IRAs must begin no later than April 1st of the year following the year the IRA owner turns age 72. Contributions to a Roth account are paid with after-tax dollars and cannot be deducted. But Roth distributions are fully tax-free, provided they meet qualifying conditions. For example, held more than 5 years, the account owner is greater than age 59 and a half. A participant has 60 days to complete a rollover IRA transaction after receiving funds for transfer. Anyone can convert a traditional IRA to a Roth IRA. However, income taxes must be paid on the traditional IRA when the account is converted. Please pause the audio and watch the video. You can restart the audio playback at any time.
Set up individual retirement accounts or IRAs and receive advantageous tax treatment. As with retirement-sponsored retirement plans, individual plans are fueled by favorable income tax treatment. It's important that you understand the tax treatment of IRAs to fully understand the importance of this way that people save for retirement. Now, one key difference between an employer plan and an individual plan is that employee contributions to an employer plan typically are made with pre-tax earnings. In other words, by contributing to a 401k plan, for example, the tax benefit to the employee is realized by a reduction in their taxable income in that year. In the case of an IRA, tax benefits are gained through a tax deduction of a contribution made to the IRA. So that's one distinction right there. Now, let's be clear about one thing. There's a lot of conversation about deducting IRA contributions and who can and who can and who can have an IRA and who can't have an IRA. For the record, anybody with earned income can have and maintain an IRA. The question is who can deduct their contributions to an IRA, and for that, things get a little more complicated. Let's begin with the definition of earned income. Earned income is basically earnings through one's labor. It is only earned income that qualifies an individual for an IRA. Unearned income, investment earnings, rental income, for example, do not qualify for IRA qualification purposes. Now, going back to who can deduct the contributions, quite simply, a worker who is not covered under an employer-sponsored retirement plan is eligible to deduct their contributions up to specified limits as specified in the lesson, which are subject to annual change. They can deduct their contributions. A worker who is covered under an employer-sponsored plan may be able to deduct contributions to an IRA, but that depends on a couple of other factors. Specifically, it depends on their earnings. If their earnings are below a minimum threshold, as identified in the lesson, then a worker can deduct their contributions to an IRA even if they do belong or participate in a qualified employer plan. Workers whose earnings exceed this threshold range cannot deduct their contributions to an IRA, although, as I'll repeat, they are allowed to own and fund an IRA. They just can't deduct everything to it. And then there's a middle range, a gradient period, where, depending on how much the worker earns, they can deduct some portion of that. And again, that's also explained in the lesson. So the thing you want to take away from this lesson is the very simple fact that every worker with earned income is eligible to own and fund an individual retirement account. Whether or not they can deduct contributions depends on A, if they are covered under an employer-sponsored plan, and B, if they are covered under such a plan, what is their actual earned income level?
All right, this is a long video, so we are going to move on. Here's the 4 questions. And turn 72, what date does she have to begin taking distributions? April 5th, 1st of next year. Which of the following will happen if a traditional IRA owner dies before all the funds have been paid out? The balance will be forfeited to deceased owner's estate. I'm not sure they got to pay taxes on the estate, but probably. Which statement regarding, because if you're getting money that he hasn't paid tax on, then somebody's got to pay the taxes. All right, which statement regarding the conversion of an IRA to a Roth IRA is correct? Income taxes must be paid on the additional IRA when the account is converted. If a person receives funds directly from a qualified pension plan and plans to turn them over to IRA, how many days must the IRA be completed? I'm going to say 90. I have no idea. 50%. So we got a couple wrong. The next one is 60 days. So you got 60 days to get the rollover completed from a distribution qualified plan to an IRA. All right, the income taxes must be paid on the traditional IRA. Got that one correct. This one I got wrong. The balance will be paid to the beneficiary and taxed as ordinary income. So whatever the beneficiary is, which could be somebody on the estate. And this one was correct too, April 1st of next year, mainly because he said that like 20 times. So that's how I remember that. All right, so I think the next video is Maryland laws. So if you're interested in specifically Maryland life insurance laws, which is not too many of you, then you can stay tuned. I will be specific in putting that in the title. So if you're looking for it, you got it. We're 60% done on this course. And you only have 3 months to finish this course. So if you have to take the course, you have 3 months to do it in. All right, thank you everybody for staying to the end.